Everybody. Welcome to all the new people and welcome to everyone that has come back. Teaching Tuesdays we did several years ago and had great success with it. We just got really busy. We stopped doing it. And then last two Tuesdays ago was we decided to start again. So we're going to be doing this the second and fourth Tuesdays of the month going forward. And we'll be talking about multifamily, and then we'll also be branching out into other parts, perhaps, of investing, single family, maybe some notes, Arun, and just some wealth strategies. Nicheole and I have to talk about it. We've kind of got our schedule out for the next 6 to 8 weeks, I believe. And I will share that with everybody in the email when it comes out. I believe it got sent out this last time, but it'll come out each time, so you'll know what's coming up over the next 6 to 8 weeks. But the whole goal here is really to share and to kind of pay it forward, if you will. Nicheole, for those of you that don't know, has been doing multifamily for close to 30 years. Incredible success, over 8,000 units across 12 states. Still buying, even though she keeps saying she's done. She just bought several hundred units in the last 6 months. So it's kind of your saying there, Bobby. It gets addictive, I guess.
Definitely.
So she continues to buy and has a wealth of information. She put together a course about a dozen years ago called Passive Cash Flow for Life through Multifamily, which is what I took. That's how I met her. I took the class about a dozen years ago, and a phenomenal, phenomenal class. It's actually now all online. Um, and if you are serious about multifamily, we encourage you to participate. Um, Multifamily is phenomenal, but you can get burned. You want to shorten the learning curve as best you can by trying to get the best education from people that are not only have done it, but continue to do it at a pretty large scale. And it doesn't mean you have to go out and buy 400 units today. Nicheole started with some duplex, well, started with single family with some duplexes and then kind of moved her way up from there. So, and I'll let her share more of that with you. But welcome everybody. And Nicheole, I'm going to turn it over to you.
Okay, somehow I kind of, all right. So hi everybody. Like I was telling somebody, I just got my old computer died that had a picture on it, and so this new one I haven't got everything fixed yet. So unlike some people, I am not highly tech savvy. I sort of bumble along and depend on James a lot for a lot of the tech, and he says that's scary in and of itself. Because so. Anyway, I was recently moved to Florida from Maryland. So I've been here just about 2 months. In fact, I think it's going to be 2 months in the next couple of days, and I'm loving it down here. And so that was actually one of the reasons I'm trying to switch up things a little bit, do things a little different. So I actually haven't been investing in commercial for 30 years. I started out in real estate about 30 years ago, but I spent about the first 3 or 4 years doing single family stuff until it finally dawned on me that if it was a single house or townhouse, it was rented or not, it was a one or a zero. And if somebody moved out for a month, I could lose my entire cash flow for that year with that 1 month of vacancy. So that sort of took me over into multifamily. And I stepped on a couple of pretty big landmines in my early years. And sometime I'll tell you about that. But it sort of started me understanding where some of those landmines are, and that it's not just about finding a good deal. You also have to find the money to buy it, and you have to manage it, or it can all kind of go away. So that's what we focus on in teaching. It's not just the acquisitions, it's also finding investors, raising the money, and then managing managers. And so all of that is kind of what we teach. Today, if you will let me share the screen, James.
Um, yep, you
Do
can
I
share.
already have the ability? Oh, never mind.
Yep.
It's already there.
Yep.
Okay, let me just kind of share. All right, let me go to, let's see, get to this thing. I have to move my thing so I can get to the slideshow. There it is. Okay. All right, so we're going to be talking about something that I don't think most people have talked about. It is a kind of a creative strategy to go about buying multifamily commercial real estate. And we're going to talk about kind of several ways you might kind of think about getting into that. But the gist is that what you're doing is you're not spending all the time and effort to try and find a deal that works and do all of the work yourself. Instead, you're focusing on finding somebody who already has bought a deal, but for one reason or another, they need a cash infusion into the deal to make it work. And that's kind of where some of us come in who have some extra sitting in some cash, where we may want to take and buy some of that equity. And so that's kind of what we're talking about today. Now, I don't expect anybody to go away from here understanding all the details because some of this stuff can get fairly detail oriented. But I want you to sort of think about the broader ideas that we're talking about here and some of the things that may make this work. So, the whole idea is that we're buying equity. To most of the time, it's to offset some kind of debt um, or to stop somebody from losing a property. All right, so here are some of the reasons. These are more of the more common reasons why somebody may need to have somebody step in and buy some of their equity. Now, I will also say you can also set it up so for people like Arun or other people who are basically lenders, you can lend money on a debt kind of deal, but I personally much prefer to be in an equity position and have some management controls so that we can avoid some of the problems that may have already occurred in the past. A lot of times, if I'm lending money on a debt, I don't have a lot of ability to have a say. So, one of the most common ones is in this kind of left-sided block there. And there, you're seeing a lot of this right now, where there is 4 or 5 years ago, people were buying multifamily properties at very low capitalization rates, four, five, six. Um, and they had loans with low interest rates. Well, we all know what happened since then, that interest rates went up and cap rates have gone up. And so, for those of you who may not know, in the multifamily or the commercial realm, you don't get a loan for 25 or 30 years. You're going to get a loan for 3 to 7 years. And the riskier the loan in the eyes of a lender, the shorter the term is likely to be. So you see quite a number of terms that are at 3 to 5 years instead of 5, 7, 10 years. And so we'll just call it 5 years. Every 5 years, that loan is going to be called due. It's going to balloon. And people have to get the whole deal refinanced. And the lenders are going to underwrite it as if it's a new loan, going through all the same processes again. And because interest rates have gone up a fair amount and cap rates have gone up, it is not unusual for a bank or a lender to come in and say, we will refinance this. So the term may be a 5-year balloon and it may be a 20, 25-year amortization, but the balloon still holds sway. So the bank is willing to carry out that amortization, but they are going to recast that loan, um, including all the terms, but most particularly interest right now. And so, what banks are doing a lot of is that they're coming in and saying that we will be happy to refinance that, but our interest rates are going to be higher, and you don't have enough at those no interest rates. You don't have a good enough cash flow for us to feel safe. So you need to bring 50, 100, 200, $250,000 into closing so that your loan isn't quite so big. Is everybody kind of following that idea?
Yep.
Okay. So here is the thing that and actually I was at a recent presentation over here and with somebody I admire a lot. And what he pointed out to me is that as interest rates have gone up and cap rates have gone up, what the bank is really saying is that this property isn't worth as much as it was before, right? So if they at one point were saying a 7 cap rate, that you would get a 7% return on your money, and now they're saying the average properties are selling at an 8.5 cap rate, then what that basically says is that the value of that property is not as high. So instead of going to that same lender, what you probably want to do is go find a different lender um, and refinance it there. And you're going to try and buy some equity. But you have to keep in the back of your mind that this property is not worth what it was when it was originally purchased. All right. So owners bought at a low cap rate and they didn't keep in mind that there is a need for a spread. So one of my hard and fast rules of buying is that I want at least a 2% spread on my money. So what that means to me is that if the cost of money, the interest rate is 7%, I need to buy it at a 9%, at a 9 cap rate. I want, or at least I need to be able to get there by the end of year one. All right. So, but a whole lot of investors haven't been that disciplined or didn't know that. And so they were buying properties at a 5 cap rate um, when the cost of money at its best was 4.5, right? We never really got in the commercial loans interest rates much below 4.5. So now they bought this at a 5 cap rate, and the cost of money for a good risk commercial loan is 6.5, 6 to 6.5. So they're underwater. That's why a lot of them are really needing to have somebody buy the equity. All right. So another area, if we're going up next to this on the top, is an existing investor wants out of a deal. So in a lot of deals, you have the management team and you have the investor team, right? Most of the investors are limited partners, and it is not terribly uncommon that an investor will want out at a certain point. And so the manager over on the management side needs to find an investor to step in. So a lot of syndications will call for the property to be sold or refinanced at 5 years. The issue right now is because interest rates have gone up and cap rates have gone up. And right now, there's a lot of downward pressure on rents because if they've gotten so expensive that a lot of the syndicators find themselves in a position of needing to hold a property more than 5 years. And so now some of the investors want out. All right. So that means there is opportunity to step into those investors' shoes and buy a place in that investment. Something not here, but is the opposite side of that, is that the limited partners typically have some say in the operating agreement if there's fraud or abuse. And so the limited investors can say they want the management team out. And so they may want to replace the manager. And so now you're looking at trying to find somebody who's able to actually manage the entire deal. Um, and so it's a question of whether those investors are going to want out or they want the management out. Um, and a lot of times you have some leverage about that, particularly if there's been some malfeasance in terms of we'll buy you out or we're going to prosecute you. Um, and that's what that green one is. Sometimes new, in fact, not uncommon, new syndicators may know how to raise money. They may know how to find the deal, but having somebody who is good at managing managers is not something that's very common on the ground. And I would actually tell you that if you were looking to go into a deal as a limited partner, that over and above all, you need to really explore the management team and how they are managing properties, what their track record is, because that's what takes most deals down, actually, until very recently when we had this interest surge, the surge in interest rates. The other area that I see a lot is that properties need a lot of work. Something has happened, there's been a flood, there's been something. So recently, in fact, those on the West Coast may remember that about the turn of the year, there were some pretty big rainstorms that came in Washington and Oregon. And a lot of rivers flooded. And I actually had one of my properties in Kent, Washington, the river flooded. 100 years it never flooded, and it took out about 6, 8 feet of my buildings that are on the lowest road there. So if I didn't have good reserves, I'd have been looking for somebody over and above the insurance to help kind of fix that up. So things like that happen. You also have somebody who underestimates the amount things are going to cost these days to fix. And so you need capital infusion, and investors may not have the capital for a capital call, so they go looking for another partner. So those are some of the common reasons. Is there any questions? By the way, if you have questions or comments, please just jump in. There's a small enough group here that we can just kind of deal with this as people have questions. So please. All right. So how do we evaluate the deal? Depending on which of these issues you're facing, your due diligence is going to be a little bit different. All right. So almost always the first thing to do is to really dig down and find out what the issue is. And then you're going to try and verify that that really is the issue. And that's what that yellow box is saying. I am always going to want the last 12 months of income and expenses. That includes the net operating income. I also want to see what reserves look like. Um, so over and above, so if you're doing kind of a typical QuickBooks where you're getting um, the profit and loss and the statement of cash flow and the balance sheet, that does not really tell me my net operating income and the status of my reserves. It doesn't necessarily tell me my cash flow system. So that's why I also want a more traditional income and expense statement, right? The P&L has some of that, but it includes things and expenses that in an income and expense statement, those expenses are going to be below the line. Um, like um, like distributions to managers, like um, the debt payment and things like that. And so it's harder to tease it out. I want to know what the terms of the current loan are. In fact, I want to see what that looks like. All right. Then this is where I want the last 2 years of the P&L cash flow balance sheets. All right. So in general, I want to know something about the market. What are properties selling for? What is the going cap rate, the interest rates? I want a basic inspection of that property. Now, I am not wanting an appraisal. I want an inspector or a contractor to go in and take a look and tell me what we have. I want to make sure I've got no outstanding violations, either code, healthcare, other things. And I want to see any correspondence that's been going on between the lenders and things like that. And the last thing I want to do is I want to see the city, county, state requirements. I just want a general picture. All right. So if I'm coming back here for a minute and we just think through this a little bit, if I've got a balloon payment coming due, what I need to know in due diligence is how much the lender wants, why they want that much, and I want to be able to see what the likelihood is in the next 4 or 5 years that we can get to this property to where my statement, my cash flow, and my exit strategies look like they're going to work. So I need to be able to means that I need to be able to see where the value adds are, what people are going to be able to do conservatively to see if this is worth going into. Now, frankly, a lot of these properties in that box are stable. They're not in bad shape at all. It's just that the terms of the loan have changed enough that the owners can't afford to come up with all that money. Okay. On those middle two boxes, I really want to know what is going on that either limited limited members want out, or the managing members want out, or the limited members want the management people out, et cetera, et cetera. I need to have a convincing story and evidence to back it up, if you're following me there. And once I have that knowledge, I need to figure out if it's something that I can fix or if I want to get involved in it, because a lot of these are pretty messy, right? This is not going to be without some headaches most of the time. Somebody most of the time is not happy. And if it's one of those things where the property needs a lot of work, I actually want to see two or three estimates of what it's going to cost and the timeline that it's going to take and what the return is going to be. So, for instance, in my poor little Kent property, I need to rebuild those buildings. And that's not going to have, it's going to, so while they're vacant, I can't rent them. And when they are redone, I'm not going to be able to rent them for a whole lot more, right? So there isn't a lot of upside. But if I don't get those rebuilt, there's a lot of downside. And so that's kind of depending on the situations, what I want to know. All right. All right. Control. Now, James will probably going to tell you that I have a bit of a control issue anyway. Um, and I freely admit that, I want to, if not be in control, I really want to be able to have a pretty good understanding of the risks and how I can mitigate those. I don't want to go into one of these deals most of the time as with nothing, with the people want nothing but my money, and then they just want me to shut up and go away. It is not in my nature to shut up and go away. So that's just the fact. And so if you want my money, you're probably going to get a little bit of my opinions, a little bit of my help, and a little bit of my work. So once you have completed your analysis, you need to determine what's the best way to buy that equity. We already talked about going to a new bank with a new loan rather than going back to the same bank and getting them to refinance it. You can buy into a deal with a guarantee that you get a preferred return. So I don't want to have a situation where I'm getting 3% return on my money, right? And so if my money is coming in, I want to have probably right now at least 10% return. When interest rates were a little more reasonable, 8 to 10% return on my money yearly. Um, I definitely want that I have the ability to have some control and say in the decisions. Most of the time, that's going to mean that we have to redo the operating agreement. And whenever you do the operating agreement, you have to get the other people that are in that deal to agree to that. So I'm going to typically go into a deal in one of the following ways: as a joint venture, all right? And a joint venture basically is everybody in the deal has a say in what's going on, and everybody in the deal does work. So there are no limited partners in a joint venture. Um, I would go in as a tenants in common. And a tenants in common is basically where everybody in the deal has an individual, separated ownership in that deal. So they are all part of the deal, but they are individually separate. And that is, if you are doing that, so if somebody is coming in with 1031 exchange money, you have to come in as a tenants in common. That's just, there isn't much other way to do that. Um, and so you may be changing the deal. I will, most often my preferred is to come in as on part of the management side. I almost never want to come in as a limited partner. Um, I would, um, it depends. I'm getting old, but 5 years ago, would be happy to be ended up the manager of of that deal because I am pretty sure I know what I'm doing, and I'm not convinced a lot of other people do, right? Um, I so the message kind of boiled down in this slide is that if you're going in, you want some kind of control in some way, shape, or form. Now, if you're new to multifamily investing and you don't have a lot of expertise, but you've got some money you want to invest, then either you look very closely at the management team and convince yourself that the only reason this property is in trouble is because it had um, interest rates, or it's in trouble because there was some type of unexpected and unable to control something that happened, like the flood that I was talking about. You don't want to go in, in my opinion, my suggestion to you, into these deals if you don't have experience in these kind of deals. If it looks like they've been mismanaged in any way. Because unless you change out the management, you change out the property manager, you change out the owners in some way, I'm not sure why you would expect to see the property go differently, if you kind of follow my drift. Okay. I was thinking, so here are kind of the brief summary of what is a tenants in common, joint venture, etc. So in tenants in common, you can have unequal ownership, but it must be explicitly stated. So um, if you are a 10% owner and somebody else is a 40% owner, that has to be stated. And most often that is elicited on the last page of an operating agreement. All right. Joint venture, everybody has a say in the decisions, but everybody also has to do work. The IRS actually wrote a very nice and very clear description of what they look for in a joint venture. It was one of the papers they wrote several years ago, and it's worth taking a look at, to actually see what they look for to make sure something actually is a joint venture. Um, Operating agreement, and I would always have a good attorney take a look at that. All right, so this last thing, let me ask, does anybody know what options are? Has anybody ever worked with options? Don't everybody talk at once. All right, so an option is a really good way of controlling a property. So one of the things, now I have freely admit I have not done a lot of these where I have bought equity. I have done short sales. So if I have a preference, I'd rather just buy the property. Um, but if I was going to do some of these, I would want to have an option included in there. So an option basically is, um, it's the right to do something, but not the requirement. So you frequently hear lease option, right? Or you hear lease purchase. But an option is something that says, I have the right at a certain time to come in and do A, B, C, or D. Um, and options are really great ways of down the road being able to take complete control of a property, or if a manager doesn't do something that they're supposed to do, um, that you can exercise the option. If the property doesn't make the return that you were expecting, you have the right to exercise the option. Um, I think those are pretty powerful. I don't think people realize the power of options. Um, they really can. So here's an example kind of out of, if you think about it, are any of you realtors out there or brokers? Okay. So say you were a realtor and you have a market that isn't doing so well. And somebody really needs to sell, but they really um, and you are an investor too, and so they really need to sell, but they want a certain price. So one of the things you're always trying to do is to get the listing. But if you were to think about saying, look at if you give me the listing and I can't get it sold, I will include an option to buy the property at what the price I'm telling you now. So either way, you're covered. If you can sell it, it's great. And if you can't, um, I will give you an option to, and I will buy it at that point. I have an option to buy it. Or there is a property in a not great neighborhood that you own. Any of you Baltimore City folk, right? But over time, that area is getting a little bit better. And so you know some people who are good at managing C minus D properties. And so what you say to them is, look, I will sell you this property today, and I'm totally making this number up, at $50,000. And I have the option, I also want an option in 10 years to buy it back from you at that same $50,000. So you have the right, but not the requirement. And so for the person who's buying it, you tell them you want 1,000 down and they're going to pay you 500 a month. And it's off of your headache. Now that obviously that means you don't have a mortgage. You need to cover your mortgage and expenses, but the power of what you can do with options is just amazing. And so including an option to cover your risks in these kind of deals makes sense. Remember, I said I may not be able to fix everything, but one of the things I want to be able to do is identify where the risks are and figure out how I can fix them. And a lot of the ways I step into those risks are with options. I think I have, yep, two more slides. I'm going to try and do this fairly quickly so we have some questions. All right, where do I find these deals? Brokers. Now you're going to be emailing or texting or calling a lot of brokers in markets where you are, and you're basically going to tell them, look at if somebody is needing to sell because they've got a loan coming due and what they just need is some money, it's a stable property, call me and I will buy some equity. Banks, savings and small banks, savings and loan credit unions, a Bank of America, Wells Fargo isn't going to pay much attention to you on this.
Mhm.
Property management companies know if a property is in trouble. LinkedIn, social media, apartment owners associations. The key is you have to get your word out there in lots of different places that you would be considering buying equity into a property if there was a need and somebody didn't really want to sell. When to walk away. All right. So these are, if I can't make at least 10% annual return on my money over each of the next 2 years. So first year, if I get 8%, I'm good. But I need to make a return on my money. When I can't have some kind of control, particularly if I feel like it's been mismanaged in a way. When I don't have the expertise to fix the issues that are found. And there are some things, so I'm just not, I just don't do development. I don't know it. I don't know much about rehabbing or anymore. And so if it was a big rehab, I probably wouldn't do it. Now, this one in Kent, I happen to own the building, so I guess I'm learning more about rehab than I wanted to know for a while. When you don't get along or see eye to eye with the current owner manager, this is the start of a longer relationship, 5 years or more. And if you are button heads and just don't get along, or all of your little um, gut is screaming, get out. This is typically when you start, this is the best the relationship is going to be. So you don't want to go into something where you just know you've got 4 or 5 years of button heads with somebody. When the market in the area is changing and not in a good way, and when the property has decreased in value, is currently selling at higher cap rates, and you can't get the returns you want, time to walk away. So this is a little one I'm working on now, just real briefly. It's a little 22 unit in Dillon, Montana. I don't know if any of you are Yellowstone TV fans, but Dillon is one of the areas where they've been filming Yellowstone. Gorgeous country. And in 19, one of a property, small property, part of a portfolio that I bought was in Dillon. So found it through the bank. The loan's coming due in November of this year, and the owner's going to need about $50,000 to make the bank feel safe with the loan. Now, this is the happens to be the same bank that I've been working with on some of these 20 properties that I bought in 2019, right? So the bank knows me a little bit. I would want to get a loan at a new bank for the current value of the property. That means that I probably want more equity than the current owner wants me to have because the property isn't valued. It just isn't worth as much. I'm trying to get 40, I'm sorry, I forgot to close my parens there. I'm trying to get 45 or 50% ownership. The owner's not really happy with that. But the truth is, they don't know how to manage and they're not managing. And what I would be doing is bringing in my management company to manage. The property needs a bit of work to get the better rents. And so there's probably in the 22 units, there's about $50,000 needed. So it's only $2,000 or $3,000 a unit, but it would probably increase the rents by $50 a month. So it's really worth doing. Um, it's got a potential for about 14% return on my money for my $100,000 if I can get 45% ownership. And I'm going to want an option to buy it if the current owner wants to sell or if the current owner can't make it work. So that's kind of, and we're just kind of getting, it's kind of a slow process, but my deal is I need to have a decision by the middle of September for me to make this work. Okay. James, I'm going to let you kind of handle this last slide here a little bit, and then I'm going to open it for a couple questions.
Awesome. So that was fantastic, Nicole. And it's funny because when we go to the questions, I got these deals that got sent to me that I wanted to talk to you about, which is apropos
All
based on what
right.
we're talking about now. And then also Arun had a question. So this is the course that I took 10 years ago, right? At the time, it was in person, it was 4 days. It felt like 18 hours a day. It was probably closer to 10 or 11, but it was like being fed with a fire hose. It was unbelievable. And it was just everything was live. And you just had a huge manual, which I still have to this day. I'm very proud that I actually kept that. And then a while ago, right before COVID, Nicheole decided that, something, why don't we put this online? We can reach a much larger audience because at the time, Nicheole lived here in Maryland. I live in Maryland. And so we had a lot of people come in for 4 days, Thursday, Friday, Saturday, Sunday, but they lived in the area. And people that wanted to come in from out of the area, like from San Francisco and, the middle of the country and stuff like that, it was a big commitment to take 4 days to actually come and do that. So anyway, we put everything online. The amazing thing, and I'll try and make this brief, but the amazing thing to me was that Nicheole was so excited about being able to record it because in 4 days of 11 to 12 hours a day, she was not able to teach everything that she wanted to, which to me was just flabbergasting. So it's an amazing, amazing, amazing course. The nice thing about it also is that it teaches you everything, literally from getting started. I've never even owned a single family, all the way to how do I make sure that the business that I build runs forever, right? Not kind of a flash in the pan and everything in between, not just acquisition or due diligence, but everything all the way across the board. It's an amazing, amazing course. The QR code is there. If you've already taken it, fantastic. If you haven't taken it yet, I really would encourage you to do it if you are serious about getting into multifamily. The interesting thing is a lot of the stuff that is taught here by Nicheole is also applicable to single family in terms of how you value property, how you manage tenants, how you underwrite, all the different things that are there. You can also apply to single family. So don't let it fool you. It's not just multifamily, but it's also mobile home parks. And there's some pieces in there about self-storage. So the QR code is there. It's basically passivecashflowforlife.com. And if you have any questions, feel free to reach out to myself for support. But my email is james@passivecashflowforlife.com. And then I'm going to ask Arun's question, Nicheole, if that's okay. And then we'll open it for questions. And then I wanted to talk to you about these couple of deals that just came across my desk today, if that's okay.
Sure.
All right. So, and Arun asked this a little while ago. I'm sorry, Arun, but I didn't get to it. But he's asking basically, what is a limited partner? What's the definition of a limited partner?
Okay. So typically in real estate deals, there's general partners and limited partners. And the general partners are generally the managers, and they are responsible for signing for the loan, for managing the deal. The limited partners typically um, they have limited responsibility and limited liability. So they are tend to be limited to what they've already put into the deal. So they are not generally included in any need for cash calls, but they also generally don't have any say in the deal. So they are just putting their money into the deal and then going away and letting the managers manage and make sure that they get their payments and stuff like that. And so it's typically give me your money and we'll do everything. You don't have any responsibilities. And like I said, that just doesn't suit my little control heart very well.
Arun, hopefully it answers your question.
So I
Any
just
other
Did
had,
that
questions?
get it, Arun?
yeah, I got it. I just had another question, which is pretty basic. Like, what is the difference between debt and equity? Like, when somebody is investing, can you just define what is, as I understand, debt is basically you getting a fixed return on your money, irrespective
Okay.
whether
Okay.
the. Mhm.
So here is so the partnership arrangement is limited, general, tenants in common, joint ventures, those describes the partnership type and what the responsibilities are of the various partners. The equity is the ownership percent. And that typically has to do in most syndication deals where somebody's going out and finding limited partners or finding investors, they own the majority of the equity. So I am totally making these numbers up. But say you are buying a property and you're in total amount of money you need to buy that property is $1 million. That includes closing costs and everything. All right. And the limited partners, for them to get, so typically what we do when we are calculating out how much limited partners or how much partners should own of the deal as opposed to the management side is you'll look to see how you make sure that you get the limited partners at least an 8 to 10% return on their money yearly. So it may not all be in cash flow. It may part of it be in the exits. But if we take that $1 million and the um, the the expected return on that property is $9,000 or $10,000 a year, then that is a 1% return. If it's going to be $100,000 return over the year, that's a 10% return. So if investors wanted at least an 8% return, that means that they need to be able to get $80,000 a year. And if the property puts off 90 or $100,000 a year, that's what the numbers say, then that means that the people who are putting the money in own 80% of the deal and the management side owns 20%. Now, a lot of deals, the management side are also going to put money in the deal. And so their contribution gets included in that 8% return if you're following that. So partnership type and equity position are different. And the operating agreement is going to describe the roles and what each type of owner is responsible for doing, the decisions they can make, etc. And typically, limited partners own the majority of the deal, but they don't have much say in anything. I'm not sure, did that answer your question? Did I get the question that you were asking correct?
Yes, absolutely. Thank you, Nicheole.
You betcha. Other questions?
Um, Virginia has children in the background, so she's coming through chat. She's asking, when you say the rate of return, you mean the cap rate?
No, I'm talking about the return on your money. So if I was taking that same $1 million, right? And I want I want a 10% return on my money every year. So in that $1 million, that means I need $100,000 every year for all the people who are owning this. So if I am holding it 5 years, then that means I need a 10% return times five, or I need an overall 50% return on that money, or $500,000 on exit. And that return is a mix of what you get from cash flow and what you get when the property is sold or refinanced. Does that answer your question, Virginia?
She's on mute. So,
Okay.
yep, she says yes.
Okay.
Anybody else? We got a few minutes left. Questions?
Yeah, I'm trying to type it. This is Bob. I'm trying to type it right now.
No, just say it.
Okay. Yeah, this is for Nicheole. Yeah, quick question. I was doing the acquisition. I mean, I know you stated that you need to assess the risk, and that's the due diligence. And I know that's very, very important. So, in that situation, I had certain situations that I had where I would typically, of course, you want to assess the risk, right? Because we got to figure out what's going on with. So the question is, if doing your due diligence, you realize that it's a lot of properties, multifamilies in particular, it's due to bad management or they couldn't refi in time, right? So can we, if we walk the property and it's locally, and we realize, I know you probably don't have the construction out like you stated, but I'm able to see this, and see what's going on. Just put a blanket number on, let's say like 600,000. And we go into this property and on the creative end of it. Uh, the seller's motivated to sell, and we realize that it's a bad management deal. Can we just wait, get them to the table fast and wait? If we see it and we can waive the due diligence side of it, and we have the deal structured, can we just waive the due diligence side, and we already can we can also bring he or she in, have a balloon, refinance them out in like 18 months, cash out, and be able to take care of what we need to take care of? Or that's
I
too risky for you?
I would say I would never, ever, 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 ever buy something without some due diligence.
Right. We did this
I
due
don't,
diligence in the beginning.
it may not be my 25-page due diligence checklist, but you can't just, so if you are a construction guy and can see what the property needs to be fixed up that way and put some reasonable numbers on it, then that would be, you may not have to go in deep on that. But that doesn't take care of the financing issues. It doesn't take care of the market issues. It doesn't take care of the things you find in the community on taxes and insurance and other things. So I would never not do due diligence. If I had a lot of expertise in a certain area, I may go light on that, but you just don't know what you don't know. And I got to tell you, I've gotten bitten badly a couple of times, and so I just don't skip due diligence. I don't know
Right,
if
right.
that answered your question.
No, it kind of did, but I'm not saying skip the due diligence in its totality, right? So you're walking through the property. We know it's an older property. We know that the heating and cooling systems need to be upgraded. So let's say like it's 50 units. Needs to be, we need to take care of that, chillers, whatever they may have. We can see that. So my point, if we see this, not to skip it entirely, and I know this I'm not underestimating the due diligence side of it. I'm just talking about, there's been plenty of times that, because my experience, I know that seller's gonna lie to you. So my point is that doing this and getting to the closing table, if we had a good idea, and I'm not saying don't do it. I'm talking bring your techs in and bring all the trades in and get a roundabout number, and we can just bring it to the table real quick. I'm not saying just get rid of that due diligence.
So this might help you, Bobby, if I can jump in real quick. Nicheole, do you
Okay.
mind if I just
No,
so
go
one of
for
the beauties of being part of the group, if you will, right? There's a couple hundred students, over time, and some we don't talk to anymore, but a lot of them are still involved. So, and this actually happened yesterday and today. So I've had 3 students reach out to me and to some others and stuff like that with some different deals. Um, what's interesting is that one of the students said, "Hey James, I need some help with this. I'm looking at this property. I've got it under contract. right? The person that bought it, this is going to relate to your due diligence, right? The person that bought it kind of walked through it, got a scope of work, it's like 600 grand, whatever it may be, and went to closing, bought it. This was like a year ago or something like that. Come to find out, they didn't check with the municipality. They didn't do all of their due diligence. They're like, you know
Right.
something? I know what I'm
Right.
doing. 600 grand, got a scope of work. I'm paying this. I'm going to make this. I know what the rents are, but I'm not going to do the whole thing. Well, it turns out the municipality will not allow them to habit or inhabitate the lower levels on the 8 buildings on the property. So it started with whatever the number was, call it 50 units, right? Which he bought. And then when he went to try and get his occupancy permits, they're like, oh, no, 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 no. You can't occupy the lower levels because of the damage that was there. You can't
Right.
use it for living. So all of a sudden, his 50 unit went to 40 unit. And now he's
Right.
like, the numbers don't work anymore. So now he's like bailing. And the student's like, oh, shit, I'll buy it, but I'm going to buy it based on, right? So I
Right.
guess case in point, and it's literally, I just talked to her earlier today. She called me yesterday. If you don't do all of your due diligence, and I get where you're coming from, sometimes you don't want to stretch it out forever, but if you miss one piece, to Nicole's point, that one piece could take the deal and make it into a horrible deal, which is unfortunately
Right.
what happened to this guy. So,
Right.
due diligence, I mean, I wouldn't let anybody push you around to try and get you to close fast. If you can't do your due diligence, sometimes the best deal are the deals you walk away from, you
Oh
know?
yeah, yeah,
So,
yeah, definitely. And I was saying the same thing because, and it wasn't that I was being pushed around. What I was trying to find is another creative way that we can get this, because sometimes the average deal is like 90 days is, and I haven't closed, I haven't taken one down yet, but I have a few things on the table, and I was just,
right.
like the one I sent, I think about a year ago, I sent to you, and we talked a little bit.
Yeah, the one in
Um,
Texas, I think it was. Yeah.
yeah, it was in Texas.
Right.
I did all that and I got one up in Silver Spring now too. So,
Right.
but I was just looking at it. They want to do creative finance, so I was just looking at the whole thing and see if there's a way that I can get to that situation. Me knowing it, understand the commercial. I got guys, but like you said, but I do agree with you were saying. You're saying, Nicole, is don't skip that one because that one may be the one come back and bite you in the butt.
Right. Yeah.
Well, I will also tell you that I've been doing this for many, many, many years, and I still don't skip the due diligence, and I still tend to learn something that I didn't expect in most of the deals that I find. Now, if I already know a market well, there are areas that I don't have to go back and do again if I've already bought in a market. But initially, I just don't want to skip because I don't know what I'm going to find. I don't know what I don't know. It's that goose egg quadrant that worries me the most. I don't know what I don't know. And sellers in commercial, sellers don't have to tell you. In
Right?
residential,
They do disclosures. Yeah,
there's a lot of
disclosures.
there is a lot of statutes that protect homeowners. Those don't apply in commercial, so they don't have to tell you. So it's on you to find out what they don't want to tell you.
Sounds good. Thanks. I appreciate
All
you guys.
right, you betcha. So James, let's get to your questions there. Let's talk about that for a couple minutes.
Sure.
And
So
then I
this is
want
the
to
kind
see if
of
anybody on the group has suggestions for topics they'd like to see us talk about.
okay. All right,
So you
great.
and
So
then them.
okay. So just real briefly, so again, the value of the community, right? So another student, got referred by another student. Anyway, I got all these deals that came in today, right? That one with a student is one of them. But these other one, two, three, four, there's 5 deals, all in the 40 to 50 unit range. And they are owned by different entities. One was a syndicator, owned 2 of them. He did some very illegal stuff. The LPs threw him out, basically. Again, what Nichole talked about earlier. And now they're just trying to dump the property. The challenge is that they're in over their heads. They don't know what they're doing. They trusted this guy to kind of run the property, and the property hasn't been run well. So there's 2 of those. There's another one that's owned by a family office, again, smaller, 40, 50 units. They don't want to be in multifamily anymore. They just want to do retail, which to me is crazy, but that's what they want to do. So they're trying to dump it. And then there's 2 others as well. One is actually student housing, which with AI. I don't know how big a fan I am of student housing anymore, but we'll see. And another one is actually on the Quantico Marine Base, which I didn't even know you could own property as a landlord on the Marine base, but I guess you can. You don't have to just be a government worker. So I guess the point here behind all this is that there are so many people in trouble now for whatever reason. They can't refinance. They need somebody to come in and help them out. They need somebody to come in with experience. So kind of this is perfect in terms of what Nicheole is talking about, is that there's a lot of people out there that you can go in and help them, whether it's with finances or with knowledge or whatever it may be. So sometimes you don't have to buy the entire property. You can go in, see what's wrong with it, see what's broken, whether it's money or the way they're running it, management, whatever it may be, and find a creative solution, to your point, Bobby, where it's a win for them, but you can kind of come in and kind of help them out. And then from that, you save them and you make a lot of money. So anyway, that's all I really wanted to share, Nicheole. There's a bunch of these, and just the value of the community is huge. So I'm very appreciative of what you've put together over the years.
Okay, so I just saw a question that came in from Arun of what is a debt investor? So there are typically in syndications, there are two statutes that basically lay out investors. There are the statute that is going to allow you to be a equity owner, and there's one that allows you to just loan money. Still as a limited partner, but you are basically now on a contract where they are contractually obligated, just like they give you a note with a mortgage. And so you basically are, you get debt. The difference between a typical a single family mortgage and note is that it's typically one or two. Somebody's in first position, somebody's in second position, right? So if there's two lenders on that, they're not equal most of the time. In a syndication, or when you hear somebody talking about a debt investor, they're typically talking about having 5, 6, 7 people who are putting in money into a debt type of a syndication, and nobody's in first or second. Everybody is owed equally, depending on the amount of money you put in. So it's just a term like a but unlike single family, you with debt, you don't typically have somebody in first, second position. This is all lenders are sort of equal, if you get my drift. Did that answer that question, Arun?
Yes, it does, Nicheole. Thank you.
Yep. Okay, so I want to know, I want to actually go down through this list because I know some of you are so talkative, not, and have you tell me one thing that you would like us to see do a Teaching Tuesday on. And I'm just going down by the list I see here. And so Bobby, you're up first.
I was typing another message. I apologize. What can you repeat that? I'm sorry.
I want to know a topic you would like us to talk about on Teaching Tuesday.
Okay, on Teaching Tuesday, how about during the acquisition? When you say coming in, you would definitely want to be a 10% manager. So coming in, how would you structure that if you coming into someone else's deal and they already are qualified? They're not. You're not. Are you going to be a non-QM or a qualifying member? You understand what I'm saying? So I'm trying to figure out if I got, and I know the percentages can be broken up. My question, wouldn't that be a conflict of interest? Because if it's my deal and you want to be my manager and you want 10%, the 10% may not be a problem, but if I'm using my credit to qualify and get the deal and I already have it, you're coming in to manage because I'm in some trouble. How would you structure that? I mean, that's what I want us to talk about, the structure
Okay,
of going.
I probably don't have time to go into that here.
Right, that's what we want to talk about, right?
Okay, well, I will put that on a potential list. All right, Arun, what would you like to hear us talk about?
Well, I'm pretty open. I'm very new to multifamily, so I'm open to anything, any learning, or I just today I learned quite a bit as far as the basics are concerned. But advanced topics also, I will definitely would want to attend those sessions. So anything and everything, whatever you think is relevant.
Okie dokie.
Thank
How
you.
about
Aisha?
buying multifamily notes? Would that fit in
Okay.
for you?
No, I buy single family. That way, it's a little bit more. It's less to evaluate on.
Okay, okay.
Yeah.
I thought I could combine both your interests into one topic. Okay.
No, I didn't quite hear that. Can you?
I had said, because he likes multifamily, but he does notes. So I'm thinking, okay, how about a topic on how to buy multifamily notes?
And what did he say?
He said he only likes single family for notes.
Okay, all right. Aisha.
I agree when you were saying the management piece of it is really crucial. So I would like to spend some time, really peeling back the layers on that to figure out the best efficiency. Um, so
Okay.
yeah. hmm
All right. Well, that's a big topic area, but I've got management issues. We'll see what we can do. All right, Dennis? Are you there, Dennis?
These on mute.
Okay. Well, he may just be recording too.
Okay.
Kim? Are you there, Kim? How about Mark?
Yeah,
Mark?
I am here. Can you hear me okay?
Yeah, great. Thank
Perfect.
you.
Yeah. Uh, I'm open to topics, certainly, finding below market properties, and introducing finding owner financing opportunities with owner financing on them as well.
Okay, good. All right, Virginia?
Oh, sure. She typed into the chat, I am new to this, so all and everything.
Okay. All right, and last but not least, Wayne. Are you there, Wayne? Okay. How about you, James?
That's funny. I wrote down what everyone else said, so I've got a list to add to what we have, but I think when you and I talked, we probably got, I don't know, 20 or 30 things that we can talk about. So I think digging into every topic, even just for an hour, I think is hugely valuable for people. So we'll just put together a schedule and go one by one.
Okay, we can do that. All right, is there any last minute questions from anybody on anything real estate related? We've got about 5, 6 minutes. So open for any question on anything, as long as it's real estate related. I don't know much about anything but real estate, so.
So what do you guys, just Bobby, how you doing? Just I probably got a whole lot of things, James. But yeah, so what about raw land? I mean, I know you're not, and you said you haven't done development, but what about the perks and as far as just land? Or you want to stick to multifamily?
So there's a couple of things that I can and have done with raw land. So some of the best things you need to be able to do is to buy it cheap, right? For the most part. So raw land breaks into two or three different kind of buckets. One is infill lots, where you just have a lot that hasn't been built on. The second is kind of what used to be a piece of farmland, which is typical development kinds of things that I don't know anything about. And the third is kind of out in the country, on country road kinds of things. And in any of those, if I can, I find the best deals when tax sales come up, when people haven't been able to pay their taxes on the land. You can a lot of times get that lot for what the back taxes are.
Right.
But instead of trying to go and buy them at tax sale, when the list comes out, I try and find the owner and talk to the owner directly to see if I can buy the land before it goes to the tax sale. Because then you're talking about competing with people who want 4 or 5% return on their money. So you're changing up how we're going at it. And then the exits, you find out in the middle of nowhere, you find people who want a hunting lot. If it's on a road, you see if you can buy the lot and set it up for a manufactured or modular home. You can wholesale the lot. You find people who are looking to build in an infill area and wholesale the lot. So the key is having an adequate exit, being clear on how you're going to get out of that. Some people are just going to hold the land, but for me, it needs to have some kind of potential of what am I going to do with it. That answer?
Yeah, that's fine.
Okay.
Right. Thank you.
Other questions? Going once? Going twice? Okay, I'll see you in 2 weeks.
Thanks, Nicheole. That
Oh,
was awesome. Thanks, everybody. Have a
I
safe
think our
night.
next class, what's our next class
Thank
before you hang
you.
up?
I was
Okay.
trying to look it up. I should have this, and unfortunately, I don't. But look for an email when we send out this replay in the next couple of days. It'll have the schedule on there for everybody.
I think the next one is we're going to get one of our insurance buddies to talk about different kinds of insurances related to both commercial and residential rental kinds of things. So you kind of get a sense of where the insurance market is and kind of what you need to be aware of. So
That's a great
it may
idea.
not be a sexy topic, but boy, can you get in trouble if you don't have good insurance.
Yes, and considering how expensive insurance is these days, it's important to know what you're buying. So that's going to be a great topic.
Yeah.
All right, everyone. Have a
Yes,
great
great
night.
topic.
All right.
All
Bye.
Thanks a
right,
lot.
thanks,
Thanks,
y'all.
guys.
All right.
Bye-bye.